Welcome to the Value Investor TV podcast. My name is Beko and my partner Hari.
Hello.
Thank you guys for joining us. We'll continue our discussion with around coronavirus and how it's going to impact, our GDP growth, what it's going to look like in Europe. We're also going to talk about how different industry segments is going to be impacted by this coronavirus outbreak. So we'll talk about these different topics in this episode. Ari, do you want to start us off with a disclaimer, please?
Yeah, this is the Value Investor TV podcast. It's a podcast that helps you understand how value investing works. We are not financial advisors, nor do we know your specific financial situation. So please consult with an advisor before making any financial decisions. Great.
In the last episode, we talked, a bit about the virus itself, different countries that are impacted by it, the response from different countries, namely Korea and Italy. In this episode, we'll talk about kind of the economic impact of this and what that means for value investors. So Hari, start us off with, what this virus could mean for kind of GDP growth across the world. Take us through that picture.
Yeah, I think prior to this, we were talking about some countries that were bordering on recession. And so what does that mean? If you have 2 quarters of negative GDP growth, a country is considered in recession. And believe it or not, there were actually some countries that were in the EU that were already looking like that. Italy has not had significant growth since 2010. They were hit heavily by a debt crisis in 2010. And now it's looking like, because of the shutdown of tourism, shutdown of a lot of different industries, they're going to require significant amounts of liquidity into their system, which means, buybacks of bonds or pumping lowering the interest rate, which is already negative, into the economy to get people to start investing. And obviously, Italy is at a point right now where they're not focused on their economy, they're focused on their public health. But, you're looking at countries like Germany and stuff also who are at the beginning of this outbreak. It's going to have a significant impact on them too. And it's going to be hard because, we're shutting down a lot of travel. We're shutting down public gatherings, sporting events that, put them in a significant amount of money into the economy are going to be shut down. Anything that's a mass gathering, so any public events, festivals, that kind of stuff are being closed. Concerts, everything. So you're seeing a lot, this is not going to be, it's not going to be isolated to just travel and tourism. It's going to be, hitting large swaths of the economy. And in some cases, like in South Korea, they've shut down anything that's non-essential, is basically is working from home at this point. So, if you look at China, they were predicting that China would be growing at around 6%. And that was a fairly optimistic number, starting at the beginning of the year. There was a lot of things going on with the trade war that kind of China had, and the U.S. had kind of worked out some things. But really what we were worried about was China had a lot of debt. They were slowing down their economy. And now they have this extra punch to the gut, which is going to be, I think they're going to probably go below, negative growth rates for at least, the first quarter and probably the second quarter too, depending on how quickly they ramp things up. So kind of what does that mean? Well, I think you're probably going to see them slowly expanding, bringing things back online. I know, things in Beijing and Shanghai have already started to open up again. Like Disneyland and things like that have kind of opened up. And, so I think it'll take time for the economy to kind of get back to normal and, things to kind of clean up. So, when we look at the U.S., though, I think we're just seeing the beginning of this. And I've already seen articles in the Wall Street Journal and, Barron's talking about how certain airlines are already looking at job cuts. The hospitality hotel industry is looking at job cuts. They're going to be reducing room rates because they can't afford to pay all their salaries, and people are just not traveling much, so they're slashing pricing because they're going to kind of have to get people to come to these hotels. So you're seeing it hit in various ways. I've heard that Hollywood is going to be hit with $30 billion losses this year because of delays in movies that were going to be released. People are not going to be going to the theaters, so they're going to postpone releases of a lot of movies. So this is going to hit lots of different areas. I think travel and tourism will be the hardest hit, but I think it's going to have an impact on everything.
Yeah. And you were talking about in the first episode about forced recession. You have to force this recession to be able to come out of this quicker. Right. And I think that summarizes what is going on right now with all these closures of sporting events, closures of events, of gatherings, of industries. The one that you were going to go into, in Florida, that was canceled. All these South by Southwest is another example that was canceled. All like school closures and all these things, forced recession. That is going to allow us to get back into the normalcy sooner rather than later. And what you talk about, from that standpoint, you mentioned like layoffs and things like that. That's impacting specific industries, but that's also going to have ripple effect across multiple segments. And one thing that I heard is, like for example, you lay people off from restaurants, and at the same time, because restaurants, they just can't keep them on the payroll because you don't have customers. And at the same time, these workers have children who are going to school, but at the same time, that school is also closed.
Yep.
So like, what do you do in that situation? You stay home, you take care of the kids, but you don't have an income at that point. So it's a massive problem societally, but also obviously economically. And what's catching my eyes in all of this is, how are people going to survive if they're totally leveraged, right? On a personal perspective, but also from the corporate perspective.
Yeah, I mean,
right?
Go ahead.
Yeah, I just wanted to add, like, from personal perspective, if you're like totally levered, and let's say you swallowed a house, that was totally beyond your means, and you loaded up on debt, and you bought this house, and now you don't have any income to pay down your mortgage, and all these things. From company's perspective, similar thing. You swallowed a big acquisition with a whole bunch of money, a whole bunch of debt, and now you can get a couple quarters of negative growth. What do you do with that situation, right?
Yeah, it's certainly going to be a problem, and I think I read an article about South by Southwest in Austin. That festival, I think it's a week and a half long. Is about $380 million for the Austin economy. And, there are a lot of people who are working in the hospitality industry there, where, they make less than $30,000 a year. And the earnings that they get from tips and other things in South by Southwest is like $5,000-$6,000 just for that week and a half. So, it's a fairly significant chunk of their income. And then, not to mention that these restaurants will close. They may not be able to employ anyone while they're shuttered. And even if they were trying to stay open, the number of tips, the number of people that are coming in are just going to be so low, right? So this is going to have an impact not just on the restaurants, but think of all the companies that are, you have REITs who are leasing these buildings to the restaurant or to the retail store or whatever. They've got debt payments that they have to meet, and they're not getting rent because the restaurant is closed. So, I mean, this will impact lots of different areas, and I think it'll take us a long time to see that. And I think a lot of people had levered up a lot because the interest rates were so low, and now what you're seeing is that they have no way of paying it off, and so we're going to have to see what is the is the federal government going to bail these companies out? These debts are going to be held by banks. What happens if the banks can't meet their obligations also? And then they're going to lose out. So, that's why you're seeing the Fed is putting a lot of liquidity into the market, $1 trillion, just to keep things afloat. But that means that the end consumer still has to be going out there to make, the purchase, right? in order for this all to work. So, it is going to be a very interesting, to see what happens, because I think there are a lot of people who are living, with less than a couple of weeks of money in their bank account. And if they are laid off, we're going to see things hit pretty hard, pretty fast.
Mm-hmm. Yeah. And, you got a lot of central bankers, not to mention the Federal Reserve, but also many, many other central banks out there in Europe and Asia announcing these, big stimulus package, to support liquidity. And to your point, it's going to be interesting to see how that all will shake out.
Yep.
One thing that, my parents told me about what's happening in South Korea is certain parts of the country, some jurisdiction is just straight up giving out cash to people below 50% income.
Yeah.
So people who are making 50%. So people who are making below average is getting, I don't know, like $200,000 straight up cash check that you have to use within a certain amount of time within certain jurisdiction to basically, stimulate the economy, kind of forcefully.
Yeah, it'll be interesting to see where this all plays out. But as we are, we are an investing podcast. So one of the things that you can do to be, to start learning about companies, if you haven't already done so, is send us an email, info@valuedinvestor.org, and get a copy of our checklist to kind of help you understand what businesses are going to be successful, what businesses are going to fail as a result of the price that we're seeing. The companies have fallen, they've got a lot of debt. Who is going to survive, who's not? And that's why you see us talk about a very conservative ratio of free cash flow to debt. That's one of the things that we look at the checklist. So you can email us, info@valueinvestor.org, or if you're also interested, you can get on our onto our Slack channel. Send us an email, same email, info@valueinvestor.org. Get on our Slack channel and ask questions of the community, ask questions of us. We have a fairly lively discussion that's going on all the time. People post great articles. They have investment ideas. People are vetting things, asking questions. So it's a great place for you to get on and take a look at stuff. So I would highly encourage you to do that. You can, while you're listening right now, just get on, open up your browser and send us an email, because I think it'll be very, very good for you. And, if you had been sitting on cash for a while, we're now starting to see some bargains open up in the market. There are some companies that have been hit very, very hard, like the cruise line industry. The airline industry is one that's been hit very hard, and we'll talk about Southwest Airlines in the next episode, because I think a lot of people really liked that company, and I like that company too. And we're seeing some discounts in the market. And I think there's going to be ripple effects into a lot of different areas. Think about home building. People are probably going to hold off on larger purchases. And so we're probably going to see some discounts in NVR, another company we'll talk about in the next episode. One company that we've talked about and everybody likes. And then, look at the, retailer, Ulta was a company that we had talked about on the podcast. And, we thought it was a great business, but it was too expensive. So, there's a lot of things to like about, this. Never let a crisis go to waste as an investor, right? We obviously hope that the mortality is held to a very low number, and everybody is safe and healthy. But that doesn't mean that we can't also use this opportunity to buy stocks for cheap. And so I think, Becco, it's probably good for us to kind of hone in on the debt part of the checklist, and maybe talk a little bit about that. Why don't you kind of tell us a little bit about what do we look for in the checklist around debt?
Yeah, so let's just pull out the checklist really, really quick. Give me 1 second. So as Hari mentioned, if you guys don't have the checklist, please email us at info@valueinvestor.org. We'll be happy to send them to you. So the checklist the large breakdown of the checklist is kind of four folds. You first talk about the business. So the first segment, really trying to do a deep dive into, is there a competitive advantage of this company? So that's the core crux of the first part. The second part is financials. And here is where we talk about the debt part. And then third is management, and then fourth is valuation. But here, let's just talk about the financials here really quick. So we asked three questions. First is, does the company have enough cash to maintain its business? Second question, does the company maintain reasonable debt levels? And three, can the company generate a strong amount of free cash flow from operations? So we talk about these three questions. And in ways, the second question really asks directly to the level of debt that the company has. But all three questions are in a way directly or indirectly related to the debt level, right? So in terms of the debt level, the metric that we really want to look at is debt to free cash flow ratio, and that has to be below 3. What that means is you should be able to pay off your debt with free cash flow within 3 years. That's what that means. And if you're seeing that number go up, that's a red flag for us, right? You want to be able to maintain that threshold of 3, preferably below 3. But that's kind of where we stand in terms of debt level. Obviously, this is coming from free cash flow, right? So, the third question of, does the company generate a strong amount of free cash flow from operations? You want to be able to answer that question as it relates to that level as well. And so that's kind of where we look at. There's also the kind of short-term liquidity problem. We also look at the current ratio to be able to see if the company's able to finance their short-term debt needs, or short-term capital needs rather, things like that. But those are kind of high level what we look for in terms of debt. That's really relevant to the checklist.
Yeah, the other thing that you want to look for is if a company has certain covenants related to their debt. So what does a covenant mean? It's that they have to maintain a certain ratio of earnings, or it may be EBITDA, which is, as we know, is not a real metric, but that may be how their covenant is written. In order for them to, for the bondholder to continue to allow them to pay them interest, if they drop below that, the covenant may allow the bondholder to call in the debt, which means that the company may have to liquidate their business, or may have to renegotiate their debts or something like that. So this is typically a catalyst that forces a negotiation between the two companies. Sometimes that negotiation is already pre-negotiated as part of the covenant, in which case, you may see a huge dilution, you may see huge changes in the business structure. So, we want to be something that is conservatively financed, that businesses are going to be very careful about how they look at stuff. And typically the businesses that are at the highest risk are the ones that lose the most money in this market. And so you have to be real careful that, oh, look, it's a real bargain. It's lost 80% of its value. Well, that 80%, maybe the market is actually right about this stock, and it may actually be wiped out. In a bankruptcy, typically the investors get nothing, right? It's the debt holders that get everything. So I want to be cautious, be very cautious about how you look at these companies, because there are businesses that are conservatively financed. If you look at a company like Skechers, which is a company we've talked about, they have a very large cash position, somewhere between $800 and $1 billion, for a company that's, only has a market cap, around $3 billion. And when they come down in price, that may be an opportunity to buy that you didn't get, previously owning this company. And you look at companies like Southwest Airlines, where a lot of their planes are actually financed through debt, right? They're going to have a very large debt level, but they also have a large amount of assets that allow them to sell some of the planes if they need to pay down their debt. So you want to be real careful about these, because a lot of people gloss over it because they want to look for the high flying business, the company that does a lot of things, does a lot of things well, but they ignore the debt level. And one of those companies that I've always admired, I've talked a lot about on the podcast, is Disney. But in order to finance their acquisition for their streaming service, they took on $70 billion in debt to buy the assets of Fox. And so I would be real careful, right, looking at these things and saying, well, they're going to be paying that off. And, in the case of Disney, it's $1 billion a year in interest expense that's being created just from that debt level.
Mm-hmm.
So,
yeah, I just wanted to add, just the kind of round out what you've discussed. Like in situations like this, debt is what really kills the companies, right? It's the greed that took over, and you've over levered yourself as a company, and now you can't pay back the debt, and people are calling back your debt. And so, like Hari said, you got to be really careful with these companies, and time to focus on the balance sheet is now, right? You got to really be careful about the balance sheet and what that looks like.
Yep.
For a short-term liquidity problem, but also a long-term liquidity problem. So got to really pay attention to the balance sheet. And you talked about Disney as an example of using debt to buy all these assets. And if you know that these assets will generate plenty of cash flow, that you're able to pay these assets, pay these debts off with cash flow that are generated from these assets, I think could be a reasonable purchase. But I think another good example of companies being a little greedy and buying companies that isn't generating much earnings or cash flow is the company that we talked about, WEX. Right? We talked about them going into the acquisition spree, going into the healthcare industry, trying to buy up the healthcare practice here and there. And healthcare practice, as we mentioned in the podcast, wasn't doing so well in terms of the earning power. So
yep.
you gotta. I mean, it's as with anything, it's hard to draw blanket statement over all these companies. You got to really do your homework and try to find the real story, as Hari mentioned in the previous episode. Try to find the truth in all these different companies.
Yep.
Sounds good. You mentioned a couple names, which we will discuss in the next episode. We talked about Southwest Airlines. We talked about MVR. We talked about, lastly, we talked about Ulta Beauty. So let's talk about that in the next episode. And before we do that, do you have any comments to add to close out this episode?
Yeah, no, I think the important thing is there are a lot of people who are losing their head right now, right? And they're panicking because they don't have an anchor towards value. The market is selling, so I'm going to sell, right? And the old adage of buy low and sell high, right now what you're seeing is people selling low and buying high, right? And that's what a lot of these businesses that have kind of made it through this have done. People are telling me that Amazon will be fine, Netflix will be fine, people are at home, they're going to be watching movies and stuff like that. That may be true, but I think what you're going to see is that these businesses will be affected too, right? People aren't going to be buying a bunch of stuff on Amazon when they can't go to work anymore, right? And they're worried about their finances. They're going to cut their spending too. Now maybe it'll affect Amazon less, and people will be cutting their spending from their local stores. I don't know, right? But these are the kind of things that you need to start doing the homework and keeping that watch list going. And I think you're going to see bargains if you haven't already. And that's why it's really important to follow the checklist, take notes, look at as many companies as you can, spend as much time as you can. You may be quarantined at home too. So instead of just sitting there and watching Netflix, maybe you should be looking at some companies and trying to evaluate which ones will be good if they hit a certain price threshold.
Yeah. Exactly. And we can help you with some aspect of that.
Yep.
This podcast.
Well, and if you get on the Slack channel and you want to ask us questions about individual companies, we are happy to answer them. We as a policy do not make stock recommendations. As we said, even though our disclaimer is very generic about being financial advisors, we want people to actually learn how to do this, right? And the best way to learn is to do the work yourself and make mistakes and understand those mistakes. And I know it may be like, well, just give me the answer and then I can get out of your way. I would rather spend 30 minutes answering a question and helping you than I would spending a minute and giving you the answer, right? I think it's very important that no matter where you end up in this is a lifelong thing. You're not going to be having access to Becco and me forever, right? So learning how to do this correctly is really important. The more time you spend doing it, the better you will get at it. And the better you get at it, the more independence you will have from your job, from everything else, right? And the more fun you'll have with it, because then your discussion will not be which company should I buy. It'll be, I found these 20 different companies. Now I need to start sifting through which one is the best 5 that I should be looking at, that kind of thing.
Yeah, exactly. And it's a like you said, it's a lifelong journey, and it's a lifelong journey, not only in investing, but also a lifelong journey in learning how to invest.
Yep.
So it's not something that you'll just pick up, in a day.
Right.
It'll take time.
Yep.
Awesome. Thanks a lot, guys, for tuning in. We'll see you in the next episode.
Thanks.